Hi, welcome back. This is Paul Chan from DLBS. Let's begin our next video together. Welcome back to our video. We're on to video 5, and today we will be talking about selling call options. So thank you for taking your time, and let's get started. So we have a nice focused agenda for you today. We're going to talk about why we sell call options and which call options are candidates for us to consider. We will talk about the differences between what is a naked call option versus a covered call option. And then we will actually again go back and do some shopping for candidates that we will use and pick one for today's example. And it will show you how to use options play to make your life a lot easier when analyzing these complex options chains, as well as talking about some recap of free tools that we'll show you at the very end, and as well as talking about how you could get more experience if you choose to use some mentorship programs we have in our marketplace. So why do we sell call options? Well, remember, options is a strategy, one of very few in the marketplace that allows us to have an asymmetrical reward to risk ratio. So what we risk as an investment, the returns are multiple times higher as opposed to a 1-to-1 ratio that you see in most investment instruments. And this allows us to have a higher return on investment, which gives us greater probability of success in the long term. And for today's video, again, remember last time, video 4, we talked about buying call options and how it costs you money, although the goal was to have that premium increase multiple folds over possibly, whereas in today's scenario we are selling call options, so you collect money right up front. And this is one of the most conservative option strategies there is, because you're collecting money right up front as opposed to using any of your own capital. And the beauty is these monies that you collect, the premiums, are received right away. And you keep these premiums from day one, no matter what happens to the price of the stock, whether it goes up, stays flat, or goes down. And especially when markets are relatively flat or have downward price pressure, this is an ideal scenario to use such a strategy as well. And if you have a covered call scenario where you own the shares, any premiums you collect helps reduce your break-even point further. So, naked call versus covered calls. A naked call is just basically a scenario where you do not own the shares. You're selling an obligation based on your own credit and margin position. A covered call is one where you actually own those shares, and you're almost like renting out a condo that you had invested in. So it adds another additional income stream on top of dividends and capital gain that you were hoping for. And the scenario here we have, no matter which one, is you control your destiny. You choose your own strike price and you determine your own expiration date. Either way, the premiums you receive are kept up front. And in the case of a covered call, because each contract equals 100 shares, so you must have 100 shares of a particular stock for every contract you would like to sell. And in the case of a naked call, because you don't own the shares, you would need to meet some margin requirements from your broker. And if exercised, you must either buy the shares or buy back the call option to offset. So we'll talk about these in a little greater detail. So naked call scenario, you don't own the stock. So there's typically about a 30% margin requirement by your broker. So they will hold 30% of the share prices in cash, locked away, but you're not investing it or you're not risking it either. So here's a scenario if a stock was trading, let's say, at $50 a share. Well, here's 3 scenarios that either you could choose a very high strike price out of the money at $54 and collect a little bit of premium at $1. You could be at the money at $2.50 premium, or way in the money at $5. And based on that times 100 shares plus the margin requirement, you can see your return per contract position and percentage varies depending on how much in or out of the money you are. So in the best case scenario, the stock price stays below your strike price and you keep the premium collected, and you can then, once expired, you move on and sell another contract. Worst case scenario though, you misjudge and the stock price rose above your strike price, in which case the buyer will definitely want to exercise the call option because there is a benefit to him or her to do so. In which case then you would either need to use additional cash to buy 100 shares for every contract you've sold at the market price and meet your obligation, or prior to expiration, even 1 day before, you would buy a matching call option to offset your position and probably take a little bit of a higher cost in the premium, and that would be a losing proposition if you ran into that scenario. And here's a scenario where we're looking at all the different scenarios. And again, look at $53, $52. Basically anything below $54 is an ideal scenario. You are keeping all the money and nothing gets exercised. And that's really your goal. So how do you determine which strike price to go with? Well, we will show you some tools using options play to help you make a more informed decision. And again, the worst case scenario is if the stock price rises above $54, the buyer will exercise the call option. And if you are doing this in a naked position, meaning you do not own the shares, then that is the risk that you take, is you being forced to buy the shares at a higher price. So if the stock is at $50 and you sold an out of the money call option, that really is the goal, because the goal is to balance good premiums received by being closer to the money, but not too close where you have a high probability of getting exercised. So let's start shopping for some call option candidates to sell. And typically we're looking at long-term horizon historical patterns. We looked at these in the technical analysis video, especially if you're using a covered call strategy. And the reason is this gives us some level of predictability as opposed to stocks that go up and down like a yo-yo nonstop. And unlike prior, where we were looking at low RSIs to buy in to catch the upside, we're now doing the reverse. We are looking at stocks that have a high RSI that is in an overbought position and has nowhere else to go but eventually back down, and this takes the stock price away from your strike price. So again, the goal is to sell call options when the price is less likely or unlikely to reach the strike price that you chose at the expiration you determine. So let us start with, again, free stock charts, and we will go to the Canadian index for the S&P TSX 60. So we will look at 60 of the largest stocks, and right now I can see ABX is at 79.85 RSI. That's very, very overbought. And as I toggle down and compare one by one for the other 59 stocks, you can see generally everybody is in a fairly low RSI position these days. So for our scenario today, we will pick one that has the highest, and so far ABX Barrick Gold is the one. And I still see mostly everything in the 20s, the 30s, the 40s, occasional 60s, but nothing up in the 79 range. So this is the one, 79. And look at this. There are several times in the last 12 months where it has hit a relatively high RSI, and look what happens every time. It does come back down. And that's really where we want to be when we are selling call options. We want the price to move away and down. So for a second opinion, I like to go to financial.com. This is based on 3 years of historical seasonal share price movements, just to validate my theory. And looking at this, the next 2 months, the price is relatively flat, so might be a good time to select an expiration that is less than 2 months. And so I log into my trader account. Your portal and visual presentation may be different for your various brokers, but the strategies and the implementation is the same. So I will go to my order management, open and enter options here for ABX on the TSE, Toronto Exchange. And based on this options chain, I've determined December 21 is a little bit too far out, so let's go with November 16. And the price should still be relatively flat at that point. So I could look at $17, $18, 91 cents if it's $17, but that's in the money. 43 cents is the ask for 18. $19 the ask is 20 cents. $20 is 11 cents, and $21 is 7 cents ask. So not much money to be had when it's $4 out of the money. So based on that, this is a relatively short options chain, but again, how do I determine what risk to take? So let's show you the options play tool. And again, we go and log in to get your free account here. And this time we're not doing the trade button, we're doing the income button, because we're collecting money here using covered calls or naked calls. I will modify and change the expiration date to November 16 that I selected. And compare. I've got $21, giving me a 97.93% of chance of expiring worthless, which is good in my favor. And once I get closer to the money, now it drops to 93%. At $19, the premium rises a bit, but I'm down to 83%. Those are all still good percentages. 65% would get me 42. Now we're into the money, and my chances are less than 50%, so I'm definitely uncomfortable with that. I did not see a forecast for the stock to drop that much, so I will go with $18. So to enter my $18 trade, the bid is 36 cents and the ask is 43 cents. So I will enter a trade, but instead of buy, I will sell. One contract, November 16. And again, I do not have to take the price dictated to me. I could go with the bid price, I could go with the ask price, I could go with anywhere in between. So I will go line up and try to get the most at 41 cents. And if I can't get that, I don't trade. That's okay. And this is how I would enter a sell call option contract. It's basically the reverse of what we did in the prior video to buy call options. And I submit the order, and that would give me $41 of income for every contract that I sell. And just to repeat in the Chinese, for our Chinese audience, the Chinese portal, again, I go to the income button, then I would modify and select November 16 and compare the percentage of expiring worthless. And again, it's 97+% when it's $21, way out of the money. 93%, 83%, 65%, and this is the one I ended up deciding upon. So let's look at what we did. Well, we have a stock here we selected was ABX at $17.46. And again, POW means probability of expiring worthless, which is a good scenario to have when you're selling options. You collect the premium up front, and when expired worthless, you're free to go and sell another one. And that's how you keep an income stream for the calendar 12 months. Different brokers have different margin requirements, but a rough rule of thumb is about 30% of the share price. And here's the various figures that we came across with the options chain, and I decided that 65% was good enough percentages for me to live with to derive $37 of income for every contract. Although some people may want a more conservative route and go with a higher percentage and take about half of the profits. The worst case scenario here would be somebody that got greedy and took $86 per contract, but then there would be less than 50% chance of expiring worthless. So that would be then the worst case scenario, where they may be forced to buy the shares at a higher price, or if they were managing the position and noticed that before expiration they could buy a matching call option and offset that and take a loss, although that's not a great scenario. And in the case of the covered call, because you own the shares, then you would be forced to sell the shares by way of assignment and collect cash at a higher price for all the shares that you bought. So not a bad scenario. Again, it's a win-win scenario when you're in a covered call position. So again, upon expiration, there are several things that can happen. If the price is at or below the strike price, you keep the premium. But if the price is above the strike price, then either one, in a naked call position, you would, prior to expiration, buy the matching call option to close out your position and take a small loss. Or if you have the cash flow, you would buy the shares outright, 100 shares per contract at $18 per share if your position is not closed, because that is your obligation that you sold. Or in the third case scenario, if you had a covered call position, you'd be forced to sell the shares at $18, which hopefully is higher the price than what you originally purchased at. But either way, you keep the premiums. So again, a quick word again on why we always recommend Canadian equities. It's a good diversifying your portfolio away from the US currency. You have a very stable and safe political climate, safe economy, one of the strongest in the G7 nations. And especially for Canadian companies such as Barrick Gold that we just showed you, the spread between bid and ask are much better than the New York markets. Here's some of the free tools that we illustrated. So again, my favorite, always we start with freestockcharts.com, and it's mainly a Windows platform. Macintosh users could use tradingview.com instead. One of the new tools, favorite of mine now, is financial.com, which has 3 years of historical stock price patterns to help forecast where the prices will be in the next 12 months. For anyone around the world, you can get your free online trading account, virtual trading account at interactivebrokers.com. I invite you to go to tmxmoney.com for options chain on the Canadian equities. Investing.com is a fabulous tool for American equities, as well as tipranks.com to get a second opinion on where the stock price is based on various analyst forecasts. FinViz gives you a nice data mining of US equities across different sectors, which is also a consideration when deciding which companies to go with, as well as a colored snapshot of the US market by sector. And m-x.ca is the portal for all Canadian options information. A wealth of information there is optionmatters.ca. And a lot of great daily podcasts from macrovoices.com that I invite you to listen. And all of these are no charge. And of course, the options play, which is free for Canadian equities and 1 month trial on American version. So I invite you to visit online at optionsplay.com/DLBS-English or DLBS-Chinese and try our US equity version for 1 month of free trial. And again, next time, please keep watching our videos and follow along. Continue your journey with us at DLBS.ca. Learn, practice, repeat using your virtual accounts. Tell your friends about us. Subscribe to our list on the website for updates and trade ideas. And one day you may be ready to try our mentoring services in our marketplace. So Thank you for watching, and I'll see you in the next video. Welcome back. I hope you enjoyed that video and found it useful. Please remember to rewind, practice, repeat, and if you found it useful, please share it with your friends and family. See you in the next video.